Most investors freeze the moment someone says, DSCR loan, as if it's some advanced Wall Street formula. It isn't. In fact, DSCR loans are one of the simplest ways to scale your rental portfolio, if you understand the logic behind them. Today, in 5 minutes, you'll learn what a DSCR loan is, how it works, and why investors love it. No jargon. No math headache. Just the truth in plain English. Let's start with the basics. DSCR stands for Debt Service Coverage Ratio. It's a fancy way of saying, can the rent cover the mortgage? That's it. DSCR tells the lender if your rental income is strong enough to pay the loan without relying on your personal income. Here's the formula in plain language. Monthly rent divided by monthly mortgage payment equals DSCR. If the rent is higher than the payment, the deal works. If the rent can't carry the debt, the lender steps back. Why do investors love DSCR loans? Because unlike traditional mortgages, DSCR loans do not look at your W-2 income, tax returns, or job history. They look at one thing: does the property pay for itself? Investors with multiple properties, complex taxes, or irregular income use DSCR loans to keep scaling without getting trapped by personal DTI ratios. Here's the twist. DSCR lenders evaluate property performance the way private lenders evaluate borrower safety: fast, logical, and numbers first. Step 1. They look at your rent, not your paycheck. Your personal income is almost irrelevant. Instead, the lender checks the market rent through an appraisal. They use a form called the 1007 rent schedule. This estimates what the property should rent for based on comps. This protects both you and the lender. If the market supports the rent, you're in good shape. If not, the deal needs rethinking. Step 2. They calculate the DSCR number. Most lenders want a DSCR of 1.0 to 1.2. Plain English. 1.0 DSCR equals the rent covers the mortgage exactly. 1.2 DSCR equals the rent covers the mortgage with 20% buffer. The higher the DSCR, the better your rate and terms. If your DSCR is below 1.0, the property isn't paying for itself, and that's when lenders tighten up or decline. Step 3. They check property risk. DSCR loans are asset-based. That means the property itself gets evaluated. Location, tenant demand, condition, market stability, vacancy risk. A stable rental in a strong neighborhood gets better pricing than a shaky property with inconsistent tenants. Your experience helps, but the property is the real star. Step 4. They review your credit, but lightly. Here's the good news. DSCR loans don't obsess over credit. Most lenders want a 620 to 680 score depending on leverage. They care about no recent major delinquencies, no open bankruptcies, no major unresolved collections. You don't need perfect credit, just responsible credit. Step 5. They set the terms based on risk. Your rate and LTV depend on 5 factors: DSCR score, credit score, property type, loan purpose, purchase, refi, cash out. Experience cash out. DSCR loans usually charge a bit more. Short-term rentals can qualify but get stricter underwriting. Why DSCR loans matter in 2025? DSCR loans are exploding in popularity because they allow scaling without tax return complications. A 2023 MBI report noted a 34% rise in DSCR loan volume, driven by investors escaping traditional underwriting. DSCR lending gives investors leverage, flexibility, and independence, especially those who reinvest aggressively. The payoff. DSCR loans are simple. If the rent pays the mortgage, the lender is happy. You don't need a perfect job. You don't need perfect tax returns. You just need a property that makes sense on paper and performs in the real world. That's the entire game, plain English. Subscribe for more science-backed insights on personality and decision-making. Educational content. Not financial, legal, or lending advice.